Welcome to the debate. It is January 27th, 2026, and if you woke up this morning and checked the commodities markets on your phone, you saw a lie. You likely saw the price of silver hovering right around, $16 an ounce? But if you walked into a bullion dealer in Shanghai, or you tried to source a physical bar in the souks of Dubai, you were likely quoted $140 or more. And that isn't a rounding error. That is a discrepancy of nearly 900%.
And that $140 price tag is, well, that's assuming you could even find metal to buy. The shelves are bare.
Exactly. We are looking at a market fracture that defies, every rule of economics we have ever been taught. In a functioning world, arbitrage closes that gap in seconds. Traders buy the cheap paper, they take delivery, and they sell the expensive physical. But that isn't happening. The gap is widening, and sitting right in the center of this whole fracture is one institution, J.P. Morgan. As of this month, their vaults reportedly hold 750 million ounces of physical silver.
And to put that number in perspective for everyone, because it is just a staggering number, that is roughly equivalent to every single ounce of silver mined globally in an entire year. One bank holds the annual output of the planet.
It's a monopoly, plain and simple. And that brings us to really the central question we're tackling today. Is JP Morgan's massive accumulation what looks to me like a clear cornering of the market? Is it a predatory scheme designed to orchestrate the largest wealth transfer in history? Or, as I suspect you're going to argue, is this something else entirely?
I think predatory is just the wrong lens to view this through. I'm arguing that this is a rational defensive hedge. We aren't looking at a crime scene here. We are looking at a desperate rescue mission for the Western industrial complex in the face of an AI and energy crisis.
A rescue mission? That's a generous way to put it. I'm taking the position that this is a calculated 15-year manipulation. A bank doesn't accidentally buy a year's worth of global supply. This is a trap, and it has just been sprung on the world.
And I'm taking the position that while the scarcity is absolutely real, JP Morgan is acting as a necessary strategic stockpile precisely because the government failed to do so. The market is breaking, yes, but JPM might be the only thing keeping the lights on in the U.S. tech sector.
All right, let's get into the evidence, because if we want to understand the intent, we really have to look at the timeline. This didn't just start in January 2026. This goes all the way back to the financial crisis of 2008. JP Morgan inherited a massive short position from Bear Stearns,
Which, we should clarify, they were effectively forced to take on by the Federal Reserve to save the banking system. They didn't open that short position. They inherited a toxic book.
True, they inherited it, but look at what they did with it. For the benefit of our listeners, a short position is essentially a bet that the price will go down. You sell something you don't own, hoping to buy it back cheaper later. For 15 years, JPM managed this massive bet against silver. But here's the trick, and this is where the manipulation comes in. While they were betting against the price on paper, they were aggressively buying the physical metal.
They were trading both sides of the book. That's standard operating procedure for a market maker. They provide liquidity.
Standard is doing a lot of heavy lifting in that sentence. In 2020, they paid a $920 million fine for spoofing and manipulation. That is a matter of public record. They were caught red-handed, flooding the market with fake sell orders to suppress the price. My argument is that this nearly billion-dollar fine, it wasn't a punishment. It was a cost of doing business. They kept the paper price artificially low so they could scoop up physical bars at a discount.
So you're implying a 15-year conspiracy then, to suppress price solely for accumulation?
I'm employing a 15-year strategy, and the smoking gun is the flip we saw just a few months ago. Between June and October of 2025, JP Morgan closed their entire short position, 200 million ounces of paper bets, and went net long. They stopped suppressing the price because they finally had enough metal. They own 750 million ounces. The COMEX, the exchange where the price is supposedly set, has less than 32 million. They have taken their foot off the brake, and they are ready to let the price explode.
Look, the timing of the flip in late 2025 is suspicious, I get it. But only if you look at the chart. You're ignoring the world outside the trading floor. You have to look at the macroeconomic reality. JP Morgan isn't a day trader looking for a quick flip. They are a systemic institution. They foresaw the industrial cliff we are currently falling off of.
You mean the supply deficit?
It's more than a deficit. It's an existential crisis for technology. I mean, think about what happened in the last 3 years. The explosion of AI data centers, the mandated rollout of 5G, the massive solar projects in the Southwest. These aren't just sectors. They are the backbone of the modern economy, and physically, they all run on silver. It's the most conductive metal on Earth. You cannot have an AI revolution without silver.
Sure, demand is high. Everyone knows solar panels use silver, but that doesn't explain the hoarding of 750 million ounces.
It explains it perfectly if you just assume JPM has better analysts than the government. They saw that the West was sleepwalking into a critical mineral crisis. They didn't accumulate this metal to squeeze retail investors or screw over the little guy. They accumulated it because they knew that without this stockpile, the U.S. tech and defense sectors would grind to a halt. This isn't a wealth transfer in the predatory sense you mean. It's a desperate scramble for strategic resources. JPM has positioned itself as the only gas station in a town that is running on fumes.
Okay, I like the gas station analogy, but let's talk about what happens when that gas station decides to charge $500 a gallon, because they're the only one left. That brings us to the mechanics of the market right now. We have to discuss this breakdown between the paper market, the COMEX, and the physical market.
The divergence is historic. We've never seen a spread like this.
It's catastrophic. We are looking at a leverage ratio on the COMEX of 24-1. That means for every ounce of silver actually sitting in a registered vault, there are 24 paper claims floating around.
Which, in fairness, works fine as long as nobody asks for their metal. It's just fractional reserve banking applied to commodities.
Exactly. It works until it doesn't. It's like a coat check that sold 24 tickets for every one coat they actually have. It works until the concert ends and everyone wants their jacket. And the concert just ended. In the first 2 weeks of January alone, the COMEX vaults lost 33 million ounces. That is 26% of their inventory, just evaporating in days. The arbitrage is broken.
Okay, can we pause there? Just to explain that, because arbitrage gets thrown around a lot. Why exactly is it broken?
Okay, so normally if silver is $16 on your screen, but it's selling for $140 in Shanghai, a trader would simply buy the paper contract for $16, stand for delivery to get the actual bar, fly it to Shanghai, sell it, and pocket the massive difference. It's free money. But nobody can do it. Why? Because you can't get delivery. The mechanism has failed. The exits are all clogged.
I agree the mechanism is stressed, but I disagree that it's purely fraud. You see it as a failure. I see it as a bifurcation. The market is finally distinguishing between two different things. There's the paper hedging instrument, which is just a financial bet, a derivative. And there is strategic industrial matter, which is the physical bar.
But if the paper contract claims to represent the strategic matter, and it doesn't, that is fraud. You can't sell a claim on something you don't have?
Or it's a repricing of risk. Look at what the traders are doing. They're rolling contracts backward. They're moving from March contracts to January contracts, demanding immediate delivery. That's backwardation. It just screams of supply chain fear.
That $140 price tag in Shanghai isn't just profit for the taking. It reflects the immense difficulty, the insurance cost, the geopolitical risk of actually sourcing metal now. You can't just click a button and get silver anymore. It's becoming unobtainium.
And why is that? I mean, why can't we source it? Because of China? We have to talk about the geopolitical angle. On January 1st, just 3 weeks ago, China dropped the hammer.
The export controls.
Yes, China refines 65 to 70% of the world's silver. They're the choke point. They implemented export controls that restrict silver exports to only 44 government-approved companies. They have effectively turned off the tap to the West. So you have China squeezing the West from the supply side and JP Morgan squeezing the market from the inventory side. It's a pincer movement.
It certainly looks coordinated, I'll give you that. But again, look at China's motivation. You see it as economic warfare. I see it as domestic necessity. China dominates solar panel production. They dominate EV battery production. They aren't hoarding silver just to hurt us. They're hoarding it because they literally cannot produce their exports without it.
The intent doesn't change the outcome for us, though. Whether it's malice or necessity, the metal is gone. And the U.S. government seems to have been caught with its pants down. Remember, the U.S. Mint paused coin sales late last year because they couldn't get blanks. The government couldn't get silver, but J.P. Morgan could. That tells me JPM knew this was coming and positioned themselves to profit from the crisis.
That's a valid point about the U.S. Mint. It highlights the incompetence of public planning versus private foresight. But this brings up the inelastic supply problem. I think this is the key insight most people miss when they say, well, just mine more silver.
Go on, why can't we just dig more up?
Because geology doesn't work that way. About 70 to 80% of silver comes out of the ground as a byproduct. Miners are digging for copper, zinc, or lead, and they find some silver on the side. They aren't silver mines, they're copper mines with a silver bonus. That means you cannot just spin up a silver mine because the price goes up. If the price of silver hits $200 tomorrow, supply won't budge because nobody's going to open a copper mine just for the silver byproduct if copper prices are flat. It takes 7 to 10 years to bring a new mine online. China knows this. J.P. Morgan knows this. My argument is that J.P. Morgan's accumulation is the only thing preventing a total U.S. industrial halt. The Trump administration designated silver as a critical mineral in November 2025. Who do you think lobbied for that?
Probably JPM.
Exactly. And who is holding the supply that the Department of Defense is going to need for guidance chips and satellites? It's JPM.
So you view them as a savior? A private strategic reserve that the taxpayer will eventually have to pay a ransom to access?
I view them as a necessary evil in a system that failed to plan.
And I view them as a terrifying monopoly. And this invites the comparison everyone is whispering about, the Hunt brothers in 1979. But I want to be very clear, this is not the Hunt brothers. This is far more dangerous.
The scale is certainly different, but the mechanics are distinct too.
It's the structure of the trade. When the Hunt brothers tried to corner the market in the late 70s, they had about 200 million ounces, but they bought it on margin. They used massive leverage. When the COMEX changed the rules to liquidation only, the Hunts faced margin calls they couldn't meet. They were bankrupted overnight. J.P. Morgan has 750 million ounces, nearly 4 times what the Hunts had, and crucially, they own it outright.
No leverage.
Zero. There is no debt on this position. There is no margin call that can force them to sell. They can sit on this mountain of metal until the sun burns out. They effectively control the global price. If the Hunts could drive silver from $6 to $50, J.P. Morgan can easily drive this to the inflation-adjusted high of $600. The math is terrifying.
I accept the math on the supply side, but you're ignoring the demand destruction side. You are assuming a straight line up to $600 because JPM controls the supply. But if silver hits 600 or even 300, the industrial users face an existential crisis. Tesla, Apple, the solar manufacturers, their cost of goods sold would skyrocket.
They'll pay it. They have to. What's the alternative? Stop making iPhones? Stop building missiles? Silver is a tiny fraction of the cost of a missile, but the missile doesn't fly without it. It's price inelastic.
To a point, but unlike the Hunt brothers, J.P. Morgan is too big to fail and arguably too big to ignore. If they start price gouging the U.S. military-industrial complex, if they hold the AI sector hostage, the government will not sit idly by. We're already seeing the Department of Energy getting involved. If JPM pushes this too far, we will see price controls, windfall taxes, or even nationalization of that stockpile.
You think the government, which couldn't even keep the U.S. Mint stocked, is going to outmaneuver Jamie Dimon?
I think the government has the ultimate trump card: the law. The wealth transfer narrative assumes the government just allows JPM to bankrupt the entire tech sector. I just don't think that happens.
I'm not convinced. The government is slow and JPM is fast. And look at the market signals right now, specifically the lease rates. This is the heartbeat of the crisis. Back in October 2025, lease rates, the cost to borrow physical silver, spiked to 35% annualized. Even now, they're sitting at 7 or 8%. Normal's 1 or 2%.
It signals extreme tightness, yes.
It signals desperation. Borrowers are paying usurious rates just to get their hands on physical metal now. And here's the kicker. On January 7th, JP Morgan delivered 8.1 million ounces on the COMEX. That was 99% of all silver delivered that day. Everyone else combined, all the other banks, all the trading houses, delivered 1%. JP Morgan is the only liquidity left. They have the market by the throat.
I see that data point, and I interpret it completely differently. The fact that they delivered 99% of the metal actually confirms my strategic reserve thesis. If they were purely cornering the market to drive the price to infinity immediately, they wouldn't be delivering. They would withhold everything and watch the world burn.
They're delivering just enough to keep the game going. They don't want the exchange to shut down. They want to bleed it dry.
Exactly. They're engaging in a slow bleed. They are releasing just enough silver into the market to keep the system from total collapse, while maximizing the premium they extract. They are acting as a rational monopoly. They are the swing producer now. They aren't creating chaos. They're managing the decline of available inventory. It's a predatory stability, perhaps, but it isn't the chaotic explosion you're predicting. They want the price to rise, certainly, but they need the industrial base to survive to pay that price.
But that still results in a massive transfer of wealth. If I'm holding paper silver, if I have a retirement account with a silver ETF that tracks the COMEX price, I am holding a promise that JPM is proving cannot be kept. The divergence between the $16 screen price and the reality of the physical market means that millions of investors are going to be wiped out when the paper market finally admits it is insolvent.
That is a risk. Absolutely. If you don't hold it, you don't own it. The paper market is undergoing a crisis of confidence. But let's look at the future. You mentioned the profit phase, JPM making $750 million for every dollar silver moves up. Do you think they realize that profit by crashing the COMEX?
I think they realize that profit by forcing a reset. The paper market is a relic. The future is physical. JPM accumulated for 15 years because they knew the paper game would end. The flip from short to long was the signal that the game is over. They are now positioned for the revaluation.
I agree, a revaluation is inevitable. The fundamentals, AI, green energy, lack of mining supply dictate that silver must go higher. But I caution against viewing this purely as a bank heist. It's a geopolitical restructuring. The West underinvested in resource security for decades. We outsourced everything to China and focused on financial derivatives. Now reality has come knocking. JP Morgan is simply the entity that realized this first.
Realized it and exploited it.
Perhaps both. But the complexity here requires us to look beyond just manipulation. We're seeing the return of hard assets in a world that got too comfortable with soft promises.
So let's wrap this up because the implications they're severe. From my perspective, the math is undeniable. We have a structural supply deficit, China has closed the gates, and one bank holds the keys of the vault. This is a wealth transfer, plain and simple. Those holding paper promises are going to lose, and those holding physical metal alongside JP Morgan are going to win. The flip in 2025 was the signal. The suppression is over.
And I'll summarize by saying that while the shortage is severe and the price will rise, we must be careful not to cast JP Morgan purely as a villain in a vacuum. They are the inevitable result of a strategic failure by the West. This isn't just about profit, it's about industrial survival. The volatility ahead will be extreme, but I expect government intervention before silver becomes unobtainium. We are going to see a battle between market forces and national security.
It is a unique moment in history. We are watching a physical commodity decouple from its financialized price tag right before our eyes. It forces the world to recognize the difference between value on a screen and worth in the hand.
Indeed. And for our listeners, the best way to understand this is not to look at the ticker on your phone, but to try and buy an ounce of silver yourself. The premium will tell you everything you need to know.
Thank you for listening to the debate.
Until next time.